Do you know how your RMD is calculated each and every year? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about RMDs, what required minimum distributions, what they are, and how they are calculated. You'll see those like and subscribe buttons down below the screen there. Go ahead and click on those if you want to catch future episodes of The Vault with Doug, Garrett, and myself. And let's go ahead and dive into this one, Garrett. Required minimum distributions. That word is out there for people, but if they haven't turned RMD age yet, they probably haven't gotten a real good idea of what all they entail. Tell people what an RMD, required minimum distribution, is. Let's start off with that.
Yeah, so your required minimum distribution, or the abbreviation there, RMD, very common phrase that retirees are just starting to learn about and start to study. Essentially what this means is that in our qualified plans, whether that's our employer 401k, a 403b perhaps, if you have a traditional IRA, essentially what this means is that if you remember how those accounts work, you essentially make a contribution during your working years and you get a tax deduction or a write-off from your taxable income in the year that you make the contribution. That can be either a sole contribution or it can be a combination of your contribution and an employer's contribution. Either way, you're going to get a tax reduction for that. You've never paid taxes on that money. Fast forward to your retirement years when you reach the age of 73 now. They've changed the law recently.
Yeah,
so
used to be 70 and a half.
Yep, used to be 70 and a half.
And then for what was it, 1 year, maybe 2 years, It was 72.
Yep.
And then they increased it to 73.
Yep, 73.
And it is on the schedule for it to change in a couple of years to 75.
75 in 2033. So that's
thank you.
That's coming up. But what that means is that essentially, whether you want to or not, whether at least currently, as we're filming this in 2025, when you turn 73 or older, you have to start taking money out of those accounts, at least a certain percentage per year. And that is a calculation that we're going to explain here later in the episode as to how much the IRS wants to see you take out of that account each and every year to meet your required minimum distribution.
Now, Garrett, why on earth would Uncle Sam give a hoot about whether or not we're taking distributions from our IRA accounts?
Well, Brice, we've never paid taxes on them, and Uncle Sam wants his taxes.
That's what it is.
Eventually, we're all going to have to pay the piper. So, it starts off as a smaller percentage of your overall account when you are in those early RMD years, but as you continue to age, he starts ratcheting that up. So you actually end up paying more as a percentage of your total account value each and every year.
Okay, so that's what's behind this. The required minimum distributions is because Uncle Sam doesn't like the idea of you tucking away money in a qualified plan, an IRA or a 401k, and then never taking distributions from that, because now he doesn't get his hands on any of that tax money that we need to run the government, right?
Yeah. He doesn't get his hands on any of the taxes.
Right.
Absolutely.
So there might be people out there who need to take distributions from their IRAs anyway, so the required minimum distribution doesn't bother them because they were having to take the money out anyway. But some people who maybe have some good Social Security checks coming into the household, or they've got other forms of income in retirement, pensions, whatever.
Yep.
They might not ever want to have taken money out of their IRA accounts. They just soon leave it in there and pass it on to the kids.
Right.
Uncle Sam says, nope, no fair.
Yep. Not when you're 73 or older.
73 or older, you got to start taking that money out.
Yep.
So then the question becomes, well, how much money do I have to take out? This is interesting to me. I don't want to do this, but okay, so I've got to take money out. How on earth do we calculate that? So that's where we get to the second part here. So we're going to throw up this this chart here for you. But in the first situation, there's two different charts. So what we're looking at now is the IRS Uniform Lifetime Table Chart. So go ahead and look at this. And here's how it works. This is only to be used if you are unmarried or your spouse is not the sole beneficiary. So ask yourself, am I unmarried? Or if I am married, is my spouse the sole beneficiary? If you answered yes to that question, then this is the chart that you want to use. There will be another chart that we use in a different situation. That is when If your spouse is not, if your spouse is the sole beneficiary and more than 10 years. So we'll get to that chart in a minute.
Yep.
But for everybody else, this is going to be a vast majority of you. Here's how we calculate this. Now, I do apologize. This uniform lifetime table chart that we're looking at is from a few years ago. So they still have the age 72 in there. You can disregard that. That no longer exists. So the first time that you have to take out an RMD is at 73. And how do they do this? What they do is they look at what the balance of your IRA or 401k was on December 31st of the prior year.
The previous year. Yep.
Previous year. So let's say it's 2025. You're turning 73 this year, and you're going to have to start taking out an RMD. The first thing that we need to know is what was the balance of that IRA, we'll call it an IRA, on December 31st of 2024.
Correct.
Okay.
Yep.
So in this case, let's say that it was $100,000.
Okay.
And in this case, let's say that the IRA owner is 76 this year. So we just look at this chart. Okay, 76. The divisor is 23.7. So if your balance was $100,000 on December 31st of last year, you're turning 76 this year. Divide that $100,000 by 23.7, and the answer is $4,219.41. That is the amount that Uncle Sam insists that you take out of your IRA that year.
Yep.
Now, that will become a taxable event. It'll count like earned income when you file your taxes the next year. You don't necessarily have to have had withholdings when you take that money out at the time. That's right. Completely up to you if you want to do that or you want to be responsible for it all in April. There's no right or wrong way to do that. Just be aware that if you don't have withholdings taken out and you get that full $4,219 put in your checking account, then you haven't paid Uncle Sam any taxes on that yet, and it will be due in April.
Yeah.
But you could have 10% held federal, some state, whatever amounts you want, and therefore you get that tax credit at the end of the year, right?
Absolutely.
All right. So then what about when you turn 77? All right. Well, then the divisor becomes 22.9. The smaller that divisor, this is the way math works, I am told, the smaller that divisor, the larger the number is going to be. So you would divide $100,000 by 22.9. Or then when you turn 78, 22. And that number keeps getting smaller. And we'll flip it over here to the other, the extension here. And this goes, their chart goes all the way up to 120. And as you can see there at 120, your divisor is 2. Well, that's just like dividing by 50%, right?
Yeah, yeah.
All right. So it's whatever you've got in there, $100,000 at 120 years old, you have to take out a whole 50% of that or divide by 2.
Yep.
And that's $50,000. So we'll leave that up there just for a second. You can pause this wherever you see your number and you can figure out how to do the math yourself if you got a calculator sitting around. So that is the uniform lifetime table chart. That is what we use in almost all cases. However, let's go over this one exception. If your spouse is the sole beneficiary, so you are married, and your spouse is more than 10 years younger than you.
Correct.
That's when you use this chart that we're putting up now. And this gets a little bit more complicated. We have to factor in 2 ages here. So let's say again, on December 31st, our balance was $100,000. Now, in this example, the IRA owner turned 75 this year.
Okay.
But the spouse who is going to inherit this turns 64 this year. Okay, then you have to look, and we'll put this up here. So go to that page there, and you find where the column says 75 and where the row says 64. And what is our divisor? 25.3.
Yeah.
So what's 100,000 divided by 25.3? $3,952. But again, this is only used if your spouse is the sole beneficiary and more than 10 years younger than you. If your spouse is the sole beneficiary but only a few years younger than you, you would go back to the other chart that we use, the uniform lifetime table. So this chart here is just a little special because if you can understand that if you were 75 but your spouse was 35, then you passed away, your spouse would have a very low RMD table to use. So they want to say, well, it's not really fair. We should have gotten the money because you were older. So they use a special chart for that. I've never myself had to refer to that chart, Garrett, but it is out there. So there you go. Those are the two charts out there. And just pause the screen on wherever we showed your situation, and you can figure out how to calculate your RMD. Most statements out there will know what your age is. So if you've got monies that say you've got an IRA at Fidelity or someplace, Charles Schwab, and you're receiving an annual or a monthly statement from them, if you are over the age of 73, you should be able to look on that December statement that you would have gotten in mid-January, right? And they will probably show you on there, hey, we are now aware that you are 73 or older. Here's what your balance on December 31st was. And here, they'll do the calculation for you. Here is your RMD for this account. Now, the question might become, do I have to take all of my RMDs out of each? Maybe I've got 4 IRAs out there. One at Fidelity, one at Charles Schwab, wherever. Do I have to take the proper amount of RMD from each of those accounts, or could I take it all from one account? If they are all true IRAs, not talking about inherited IRAs or SEP IRAs or simple IRAs or 401ks, if they are all the same exact registration, a traditional IRA, then you are not required to take it all out of each and every individual
you don't
account.
Take it out of,
you could add it all together and then take all of your RMD from just one of those. Uncle Sam will be fine with that. But you can't go and commingle that with, say, a simple IRA. If you've got a simple IRA out there and 3 IRAs, you have to add up all of the IRAs, take that from either all of those or one of those, and then your simple IRA, that RMD has to come from, even though you're using the same calculation, that RMD has to come directly from the simple IRA. So there you go. Garrett, anything else to add to that?
No, I was just thinking it's that different life expectancy chart. I've only got one situation where I've ever had to look that up.
Oh, is that right?
So, yeah, we've got a really big discrepancy in age difference between husband and wife.
Yeah, it's not very common that that's used, but if that is your situation, you would want to refer to the second chart that we put up there. Yep. Well, that's going to wrap it up for this episode of The Vault. Thank you for joining us. You again see those like and subscribe buttons down below, and you've asked yourself, why aren't I being caught up on all the Vault episodes by the Wealth Guardians? It's because you haven't clicked on that subscribe button yet. So go ahead and click on that, and then we'll pop up every time we have a new Vault episode out there. So that's going to wrap it up for this episode of The Vault. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault. Hey, it's Brice Payne with the Wealth Guardians. Thanks for watching our weekly series, The Vault. Do you know we also have a weekly radio show where we discuss all things retirement? You can listen to the Wealth Guardians radio show live on 94.5 WPTI in the Triad on Saturday mornings. But if you miss the live broadcast, you can also catch it on our YouTube channel or find us on your favorite podcast platform each Saturday morning. Make sure to subscribe wherever you listen so you can get notifications when we release new episodes. Want you to remember, good retirement plans do not create themselves. We'll talk to you soon.